Howdy, Jacob here. Today we're looking at Flowserve Corporation in the machineries industry, 7.9 billion market cap on 8.4 billion enterprise value. They design, manufacture, distribute, and service industrial flow management equipment globally. They've been around for almost as long as America. Founded in 1790, been around for multiple centuries. Very impressive, but not as impressive is their revenue decline over the last 10 years. We are seeing it up from about 5 years ago or so, very abysmally, but you're looking at a pretty much flat business. Gross margin going down, operating margin going down. Don't like to see those figures doing that. They pay a dividend, but they haven't increased it over the last 4 years or so because again, margins are going down. So not as impressive. Return on invested capital, very poor. So it makes sense they're paying a dividend. If they're not getting a good investment to reinvest back into the business, just hand it back to the shareholders. $500 million in cash-like products with 66 million short-term debt, 1.2 billion long-term debt. That $1 billion roughly is going to be 3 to 4 years of their free cash flow, 4 years on a 5-year average basis. And so it's going to take, if they were to allocate 100% of capital to debt reduction, they could pay off their long-term debt in 4 years with the cash on hand that they have. Obviously, that's not what they'll do, very likely that's not going to be what they'll do, but it's a good metric to look at to see how much debt they have. And so that's not a terribly large amount. 2 times is better in my eyes, because then if you need to lever up on a big return and you don't have cash for it, I don't mind increasing that at the moment. But to sit around on 4 times, a little bit more than what I'd like. Free cash flow has gone down over the last 10 years, but CapEx has also gone down. So they're going to have to find a way to increase that cash from operations. They're paying a dividend, locking up about 30 to 45% of their free cash flow, depending on what year you're looking at. On an average basis, it's about a third, maybe a little bit more. And so I wouldn't like them to increase that dividend anytime soon. And really, they're just buying back shares to offset stock-based compensation. They're getting pretty close to that. So that's enough to get me to make some assumptions here. For revenue growth, I definitely don't think we're going to be looking at anything crazy impressive. I'll probably go with 2% or so. They do have some net debt here, so an 11p price to free cash flow makes sense to me. For margins, at least they've been making money almost every year. Maybe let's do 4 and 4.5%. Share change relatively flat. Keep that dividend flat. And again, a company's review that stock price is nowhere near today's value. And so been a little bit boring the last couple companies I've reviewed, but again, that's why it's essential to quickly review a company to see if it's in a price range that makes sense to you. And if not, you don't have to waste more than 5 minutes on it. Hopefully you enjoy this video and have a great rest of your day.